Do you want the broadest pool of buyers? You see the difference? Physical gold, physical silver have the broadest base of buyers simply because they are used in every single sector of the global economy. Unlike this garbage and the fiat money garbage, we've got leverage levels that frankly are rising like they did in 2006, and they're well above where they were in 2006. Here we are in leverage, right? So leverage is debt upon debt upon debt upon debt. And EBITDA, which you see here, EBITDA, earnings before interest, taxes, depreciation, and amortization, right? So I don't care what they say. Here is the evidence of the level of leverage that is in these corporations here in 2022. They can't pay these loans back. And let's see, what were those loans used for? Many of them, surging demand for leveraged loans propels dividend payouts to record pace. Dividends, right? So the payouts, once they borrowed this money, it didn't stay in the corporation to make the corporation better, to expand, to generate more money. Heck no, we don't need all that money. We can borrow it cheap and easy. So we haven't entered the fourth quarter yet. And actually this only goes, this goes through 2021, but you can see how much higher surging demand for leverage loans. And these loans were paid out in dividends. That's pretty substantial. And the key here that I want you to really think of is that once that money goes out of the company, it is no longer available to run your business or repay debt or frankly do anything else. Thanks a lot, Federal Reserve. I think much as you want to say the banks are in a better position, which I don't believe anyway, it's not. Look at all the derivatives they're holding. But the corporations are in a much worse position. These are the guys that you bailed out in 2008. Yeah. Good job. You don't know really how risky a lot of these corporations or municipalities really actually are, because Moody's does, in all the credit rating agencies, well, I don't know about all of them, but the big credit rating agencies, they're competing to rate the credit how they get paid. So that would be like me paying you to rate this video. You're going to rate it bad? No, because if I've got somebody over there that's also willing to pay me to rate it, I'm going to rate it higher. So that's part of the problem that we're dealing with now. But according to Moody's, weaker covenants, these are investor protections. Covenants are investor protections. In recent leverage loans to allow for more debt and shareholder returns, not lender returns, because you buy a CLO, you are loaning them your money. Shareholder returns, paying out the dividends so that the money, they can even take on more debt to send that money to the shareholders, not keeping it in the corporations. Leverage loans issued in 2020 provide borrowers with extraordinary capacity to incur debt and pay dividends to equity holders at their lenders' expense. I can't tell you that anything's going to happen by Tuesday morning at 8:35. But what I can tell you is that they know that they've got a big problem with the CLOs, but with this whole transition, everybody's mortgages, car loans, credit cards, any student loans, any debt that you're holding, you're going to open up that statement after this transition, and what you owe is probably going to look a whole lot different than what you think you owed or what your last statement showed you that you owed. You're not going to be happy about it. I've been telling you forever, central banks are between a rock and a hard place. It really doesn't matter what they do. They're going to mess it up. There is no path to this. And so between 2009 and 2022, the banks have not wanted to show the bad debt on their books. So what they have done is simply loan these corporations that couldn't meet their debt payments anyway more money so that they can at least pay some of the interest on the debt. Maybe not even all the interest, but at least it enables the banks to not classify it as a bad loan. Are they going to be able to continue to do that? Because what we see is the share of these zombie companies, thank you Japan, because Japan's really the one that introduced that. In 1990, the share of public countries with interest coverage below one, went from 6.6% to 20.2%. So what's happening to these corporations inside of this regime shift, especially with the interest rates going up? Can you start to see the problem? It's like if your interest rate was held at 1% and you could barely manage to make that payment, or maybe you couldn't even make all of that payment, and then all of a sudden it went to 10%. Well, if you couldn't make the payment at 1%, you think you're going to be able to make it at 10%? How much more does that impact your debt? Does that make sense? No, it doesn't. But these are the crazy, insane times that we're living in, where debtors are far more important than lenders, right? They're gonna remove your investor protection and take on a lot more risk and a lot more debt. And I'm wondering how much more the big banks are willing to cover so that it doesn't show the bad loans on their books. How much more can they? Forget even willing. But there comes a limit, and I think that we are very close to that now. There's gold, and it's dropped 10% in spot gold contracts, while at the same time in the physical world, they're breaking out, because in the physical world, that is a true supply and demand market. China's premiums are the highest that they've been through the last two crises, because demand has exceeded supply.